headed for a recession? Is there going to be a recession in 2025? A lot of people are asking this question, and you should be too. And you've probably heard me say the answer to that question is yes. We will go into a recession. And I've given lots of reasons why, but I think today in this episode, I want to go to other people's opinions. I want to talk about what other people are saying, what the research is showing, and why we are getting closer and closer to the edge of the cliff. And the edge of the cliff is a recession. My name's Chris Naugle. This is What Now? What's next for 2025? As I look at the research and I really study what's going on, it's not hard to see the path we're on. The path we're on is one that if we look in the rearview mirror, looked really good. The longest bull run in history, the market setting all-time highs, but all of that is smoke and mirrors, especially looking at it from this seat right here in 2024. We're looking in the rearview mirror. Now let me ask all of you a question. Has any one of you ever driven your car by solely looking in the rearview mirror? Is that how you drive your car? Now, I know there's one of you out there that drives their car in reverse to and from work, but most of you look out the front windshield and you only use the rear view when you're backing up for very short periods of time, right? So why is it that so many people handle their finances, their investments by looking in the rear view mirror? Why is it that so many advisors give advice based on rear view mirror looking? I don't know, but I can tell you it's wrong. Because if we just look in the rear view mirror, all we're going to see is the longest bull run in history. All we're going to see is unprecedented money printing. All we're going to see is artificially low interest rates. All of those things are good for an economy. All of those things are really good for the stock market. But when we stop staring in the rearview mirror and we look out the front windshield, we are going to start seeing a lot of things that don't look so good. And again, disclaimer, do not get in your car and try driving it looking in your rearview mirror and then trying to blame me for the car you hit, the wall you go through, or the business you crash into. Because that's what will happen if you drive your car looking in the rearview mirror. So coming over here, Fox Business just had an article that was posted, and it basically says this: there may be trouble looming on the horizon for the US stock market. Now, this is according to research done by BCA, and they're talking to their global strategist, and what he's saying is we will enter a recession. He said this should have already happened. He said that the S&P 500 could tumble to 3,750, which marks a 30% drop from current levels. Now, there's other economists out there that are saying we could see as much as a 60% drop from where we're at, because we are pretty much coming off of all-time highs. But what else is out there that's driving this strategist's opinion? Well, I mentioned a couple. He's saying that we're coming to the end of this unprecedented money printing. He's saying that all that money that was printed back during the pandemic is now starting to see its way through the markets, and now there is no more new money being injected. A matter of fact, the Fed, as you've seen, has made a lot of comments recently that hint to what BCA is talking about. They've hinted that they're going to keep rates higher for longer, because they're trying to get inflation from where it's at now, which is still higher than where they want it this far into the game. They're trying to get it to a target of 2. How they do that is through monetary policy. Things like keeping interest rates higher. What happens when you keep interest rates higher is people don't want to spend money because it costs so much. Hence why we have a really big real estate problem right now. And that real estate problem actually could be good for one person, bad for another. But when you look at real estate, there is a massive demand for housing. But this is what they're not telling you. There's a massive demand for housing at prices you can't find right now. With the median home price being around $450,000, there's lots of demand under $400,000. Everybody and their brother wants a house under $400,000, but they are really hard to come by. Home builders are slowing down because this is the problem. They can't build houses at current prices of materials to suit the need, to suit the demand. The supply could be there, but not at the price the demand wants. And all of this hinging on higher interest rates than we've seen in the past decade or longer. We got too used to artificially low interest rates. Therefore, now when somebody is looking at selling their house that might suit that demand, they're like, you know what? I'm not going to sell my house because I've got a 3% mortgage, and if I sell, I'm going to be at a 7% mortgage, and I'm going to buy a house at a higher price. So even though I can sell my house for a higher price, I still got to buy another house at a higher price. So the only people that are selling are people that are downsizing, moving for a job. It is not a normal market, which artificially makes it look like there's so much demand. But the demand is unrealistic given the times we're in. Therefore, let's go to the next topic. Things you want to buy. Cars, boats, all these things. They're all slowing down. Now I know if you look in the rearview mirror, you see the earnings reports from last year, which look really good because people were buying cars. There was a big frantic run on cars after the pandemic. But now, actually, you go to a dealership and you talk to the actual people selling the cars, they're saying they're seeing a slowdown. And if you think the demand for EVs is going up, boy, you have been living under a rock because the demand for EVs is in the tank. That's why there's rebates after rebates and discounts after discounts on EVs. Because ain't nobody that I know wants to drive an EV. Anyway, even if they did want to drive one, the interest rate's higher. So let's get on to a couple more things that I want to hit on. Right here in this article by CBS News, they talk about interest rates, which I just hit on, but they talk about what Jerome Powell is saying. And Jerome Powell is literally saying that although they're getting results from the higher rates for longer, they are still saying that they are not where it needs to be. So when you look at the article, we can basically assume that the Fed is not going to be so quick to drop interest rates to appease the market. So can the market hold out? Well, I did another video on YouTube, and you should check it out, where we went back 5 presidential elections, and we looked at the last 5 presidential elections, hyper-focusing on presidential elections where a candidate was running for a second term. Can any of you take a guess as to what the stock market was doing each one of those presidential elections right before the election? Well, if you guessed it was going up, you are absolutely right. But can you now guess what happened after the presidential election? And it doesn't make a difference whether it was a Republican or a Democrat. So get that right out of your head for this left-right divide that's going to end us in a civil war. We'll cover that in a second. What happened was the market fell steeply in some cases, no matter who got in office. It didn't matter whether it was a Democrat or Republican, the market fell. So what does that tell you? It tells you a couple things. It tells you the markets are manipulated prior to an election. It tells you there's a lot of speculation before a presidential election. And what do you see today? Manipulation, speculation, and the craziest stock market activity I've ever seen in my professional career, where 7 stocks, the Magnificent 7, are dominating the S&P 500. Remove the 7, remove those Magnificent 7, the S&P 500 starts to look a little bit more like the Russell 2000, and that doesn't look good. So let's also talk about the one thing that everybody seems to love to talk about, and that is unemployment. Unemployment's been really low since the pandemic, but that just kind of makes sense. Let's think about what happened. The pandemic, we're here in New York, we were shut down for almost 2 years. We were shut down, then we were opening, then we got shut down again. It was something like that. I'm trying to forget that period, but everything shut down. And then when it all opened back up, everybody went back to work. When unemployment checks started running out and all that money that was just being given to people for sitting home started to dry up, people went out and got jobs. They started over. They got back in the driver's seat, looking out the front window, not the rear view. But when they did that, that resulted in very low unemployment numbers. Now, a lot of people give the president a lot of credit for this. Now, I'm not going to make this political, but it really wasn't the president that did this. But I will give the government some credit. The government created an unbelievable amount of government jobs. So when you look at the jobless claims, when you look at the jobs reports, what you will find, it is largely manipulated by government jobs. So when you think everything is great, yeah, it's great because the government's employing more people. Now, where else are jobs? Well, jobs are in service, airlines, things like that. Travel, a lot of people have been traveling, but that's even slowing down. Maybe not now because it's summertime, but you know, I called last summer revenge summer. This is like the return of revenge summer part 2. It's kind of like that movie sequel. You watch the one, you're like, oh man, they're gonna make a sequel. Oh, there it is, number 2. This is Revenge Summer 2. When you travel, you see a lot of people travel and they gotta get it in. Who knows when the government's gonna close it down? I mean, we got a presidential election coming up. But let me get back to it and get out of this rant. Right here, Fox Live. Goldman Sachs on US jobs data, and this one's talking about the jobs report was softer than expected. Now, we had a discussion earlier about job claims, right? About, not job claims, about job reports. And we were talking a little bit about how the overall reports every single time seem to get revised. Every time the report comes out and it looks good, a month later we hear that it was revised and it's not so good, but everybody forgot because all they heard is it was good. They heard good, okay, and then went back to their lives. But then it's revised and it's not so good. Well, right now, unemployment is sitting at 4.1%. Now, historically, that's really good. But here's what's not good. It's ticking up. It's going up. Every time they do these revisions to the original job reports, the numbers are going up, which means the economy is softening. I mean, it's right here in this article. You guys can look it up for yourself. And the funny thing about this is we're not getting the whole story. And that's, I think, the bad part. We're not getting a true picture. When we see the news, when the reports come out, we think, oh, everything's good. Oh my God, the economy's still strong. Wow, look at all the new jobs. It's flipping now. So now they can't sit there and blow smoke up our beep. They have to tell us the truth. And now we're starting to see that, and it's going the wrong direction. But not only that, here I thought this was really interesting. You have all probably seen the US debt clock. Well, I've got it up here right now. Now, the US national debt is a lot of numbers, and man, that is moving fast. Man, that's like Ferrari speed right there. If your Ferrari accelerated right like that, you don't have a Ferrari, you have yourself a supersonic jet. That's right, 8, you get the drift. 1,000 and then, you know, all the other stuff. But here's the important thing to look at. Debt per citizen. Per citizen in the United States, the debt per citizen is 103,521. But that's not the important one. We can't go by citizens. We got to go by tax-paying citizens. Because you all know, as they print more money, make more debt, who pays for that? The government? You think the government's paying off this debt? You actually think that, where do you get your information? No, you are. Silly? Come on, the taxpayer's paying all this. So how much is this per tax-paying citizen? Oh, it's only $266,954. That's crazy. That number just changed while I was watching that. That's all. $266,954 per United States citizen that pays taxes. Kind of funny how that works. Like, not all citizens pay taxes. And I know some of you are like, oh yeah, all those wealthy idiots, they don't pay taxes. Bullshit. They pay a lot in taxes. But they know the tax code. So maybe from a tax rate percentage, they might pay a lower percentage than someone making less money, but that's just because they have good CPAs that understand the tax code. But I don't think that's the important part. When you come over here, it says U.S. federal tax revenue. $4,927,328,000, and the rest is moving way too fast. That's $14,669,000 per citizen. So the debt per citizen is $103,521, but the revenue per citizen is only $14,669. Are you seeing the problem? I am seeing a problem, but hey, you can help solve this problem. That's right, pay your taxes. And while you're paying your taxes and you're pretty pissed off, I'm gonna do something fun. Click the subscribe button, because when you're pissed, there's no better time to click the subscribe button. But another thing you can do is right up above, yeah, there's a bell. It looks like this little punching bag. Yeah, when you're pissed off because you just got your tax bill, you can just punch the little bell, like smash the bell, like we always say. Now, on the other desk, when I hit it, it just goes flying. But this one, Wilson, it's okay, Wilson. This one, oh, that hit the car. So back to the US debt clock. Total worker compensation is 14 trillion. Total federal, state, local spending is only a little 10.7 trillion. Let's see, total debt to GDP ratio. This is the most important number, but it's really small on here. Total debt to GDP, gross domestic product. What do you think that number should be? 70%, like 80%? You should never have more debt than you do income, right? If you lived your life where you spent more than you made, what would happen? You'd go bankrupt, right? Eventually you'd run out. The credit would dry up and you wouldn't be able to pay off your debt. So if you were the government, how would you want the debt to GDP ratio to look? Well, the sweet spot would probably be about 70%, because that would allow them to basically take the 30% that they're not spending and they could pay down debt. That was always the sweet spot, 70 to 80%, okay? And in your household, that would be your sweet spot too. If you spent 70% of everything you made, but you saved 30%, you'd be doing really well. If you spent 80% of everything you made, but you saved 20%, you'd be above average. Even if you spent 90% of every dollar you made, but you saved 10%, then you'd still satisfy the first law of wealth, which is keep 10% of what you make. Yeah, but if you're the government, you can do 135.53% debt to income. That's right. You could spend 135% of what you make. Does that make any sense? If you did that, it wouldn't go well. Let me just put it that way, it wouldn't go well. But that's what the government does. That's what this shows right here. And it's insanity, pure insanity. But you know what? Let me get over here to one other thing. There's a couple of people that I think you should really pay attention to. I talk about Warren Buffett a lot. He focuses on fundamentals. He doesn't invest out of emotions. He invests solely by logic and by doing his due diligence. Very few people do that. They emotionally invest. They hear something that's gonna go to the moon and they throw their money into it. Just like, I mean, listen, I'm not putting down Bitcoin, but like, how many people jumped into Bitcoin when it was on this last run? Have you looked at Bitcoin recently? Yeah, it's down like 20-some% off of those highs. How many people put money in at that highest point because they thought it was going to the moon? Oh, a lot. And now it's off that high by 22. Now, I'm not just picking on Bitcoin. People do this with stocks. People do this with mutual funds. People do this with ETFs. They throw money into things that they have no knowledge about. They don't know, they don't like, and they don't understand what they're investing in, yet they still invest in it because emotions. Folks, if you invested using logic, you'd make a lot of money. But Ray Dalio is a very logical billionaire. Matter of fact, Ray Dalio started the largest hedge fund in the world called Bridgewater Capital. He's written many books, which I've read. They're thick and heavy books. One of the books is Principles. We're going to talk about principles in a second. But Ray Dalio right here is warning the United States of America. He is saying that you are on the brink of collapse. He's saying you are literally, and maybe collapse is a strong word, but he's saying you're literally walking to the end of the plank. But here's what scares me the most. In this article right here by Fortune magazine, it says billionaire investor Ray Dalio warns US is on the brink and estimates a more than 1 out of 3 chance of a civil war. Listen, I don't want war. I don't like war. A lot of people lose their lives fighting for the freedom, and they have in this country. So I'd like to give a quick shout out to all of our military men and women. I'd like to give a shout out to all of our vets and our first responders. Thank you for your service, because freedom is not free. We just had 4th of July, the Independence Day celebration. We must understand that none of that came for free. So if you're looking for free handouts, there's this country called China. Just get on a plane and go over there and stay there. Because they're communist. You just basically I guess everything's just given to you, or at least that's what you think. That is not the United States. The United States is the land of the free. But that freedom cost a lot. So he's sitting here talking about a civil war. I don't want a civil war. Have you studied the last civil war? 1 in 3 chance. Sorry, that's frightening. Okay, then when you get into some other articles, which we're not gonna go into all of them, they all point the same place. Just like I opened, a recession. It's imminent. The inverted yield curve is still inverted. What does that say? It says there's a lot more risk in the short term than there is in the long term. Why? Well, because a recession's coming. It's never been wrong. And all the other things that I'm always talking about, folks, just get your house in order. I got plenty of videos that show you how to get your house in order. But let me just read you just a few things, and I think this is a really important tips. They're not my tips. But again, I didn't want you hearing my opinion. I wanted to read you articles today. So here's some articles or some tips from Ray Dalio. Now, again, remember Ray Dalio is a billionaire. He's a billionaire that ran the largest hedge fund in the world. Do you think he knows a couple things? He does. He said, number one, assess your financial risks. You understand that, right? Risk versus reward. Assess your family's financial risk. If you're burdened in debt, you are at high risk of failure, okay? He mentioned that about the United States, but it's no different for your family. You cannot operate your family at 135% debt to income. You just can't do it. The United States can't do it either, but they're playing God. I don't know what they're doing. They're just printing money, and eventually, I hate to say this, but Germany might be kind of the path. Anyway, I don't even want to think about that. Principle, if you worry, you don't have to worry. And if you don't worry, you have to worry. Interesting take. He talks about action. Worrying helps identify personal risks and take action. He then talks about and gives an example. He said, consider the location you live and you work. Dalio's Health Index rates nations on various factors to help assess risks and strategies for living and investing. You know, you've heard me say that the United States, although not what it used to be, is still the nicest house in a really neighborhood. The neighborhood is the world. In other words, the United States is still the best place. Why do so many people want to live here? Why don't they want to live in China? Why don't they want to live in Russia? Why don't they want to live in all the North Korea or South Korea? Why? Well, I'll tell you why. The United States of America is still the land of the free, the greatest country on earth, the land of opportunity. So when you're looking at risk, sometimes you just got to look at where you live. Flexibility. Be open to moving if necessary. But I'm going to add on to what Ray Dalio is talking about, flexibility. Be open to change. Everything changes, folks. Life is a series of changes. If you're not willing to change, you will be stuck and you will suffer terribly from that. Inflation. He said, measure financial risks in inflation-adjusted terms, ensuring emergency savings are also in a diversified, safe portfolio. So what he's saying is when you're looking at the future, whether it be your retirement, whether it be your savings, whether it be just anything you're looking at, adjust it for inflation. And usually, I mean, we've been in heightened inflation, but usually we're gonna wanna use between 3 and 4%. What that means is your money has to grow by 3 to 4% just to keep up with inflation. Inflation never goes to zero, okay? It hovers right around that 3% mark. So when I was an advisor, we always would use about 3.4% indexed for inflation, which means your money must grow in excess of that. So if your money's sitting in a bank account, sitting in a CD, sitting in a high yield savings account, and you think that's gonna be your long-term plan, that is never going to actually work for you because you will be losing more than you're making. Maybe right now you're making a spread, but that's because we're in a heightened interest rate environment. Now earlier I mentioned the book that Ray Dalio wrote. It's called Principles. In that book, he covers a lot of things, but one of the most important things I want to hit is a video that he made out of that book, and it's called How the Economic Machine Works. You can just punch that into Google, and his YouTube video will pull up, but please watch that video. Watch all of his videos, but he also, with the book, puts out free white papers. Now, I know everybody's got a lot going on, but I have read almost all of Ray Dalio's white papers, and the white papers are the best part. You can read the book, you can watch the videos, they're great, but the white papers are where the truth lies. Those white papers will literally give you a destination of where we're gonna go. Absolutely. So check out the white papers, read the book Principles from Ray Dalio, and watch his multiple fun videos that he's created on YouTube, starting with How the Economic Machine Works. Continuing on, Save and diversify your portfolio. He talks a lot about diversification. You can look at his, what they call all-weather portfolio, just by Googling Dalio's all-weather portfolio, and you'll see how he diversifies or how he recommends diversification. In there, he recommends 55% in short and long-term bonds. I talk about this all the time. But he also warns that for long-term, you might want to be careful of US bonds. Well, I think you can understand why. Shall I tell you why again? 135.53% total debt to GDP. Debt, US Treasury bonds. But in the short run, we're still okay. All right, keep going on. Avoid pulling all of your money out. Avoid putting all of your money in one place. Cash isn't safe due to inflation. Wow, thanks, Ray, I just said that. Diversify with inflation-indexed bonds. Physical assets like gold and potentially digital assets like cryptocurrencies. And he also says hedging. Now you may not know that term, but you can look it up. Consider small investments in assets like Bitcoin for investments, hence small. Don't go all in. Don't be like, oh, I'm gonna put it all in Bitcoin because it's going to the moon. That wouldn't be working out. Diversify. Put small amounts in different baskets of things that you know, like, and understand. Listen, folks, I could go on for an hour. I don't even know how long I've been ranting here, but just know the future, the front windshield does not look nearly as good as the rear view mirror. Where we're going is going to be hard times. And I think that's the only place we can go. Things have to reset. Recessions, although bad, because it makes things harder, are actually good. Think of it as a cleansing. That's exactly what it is. A recession gets rid of all the hanky-panky. It flushes the markets, it allows them to reset, but the Fed always intervenes, and they will intervene. So make sure you get ready. So folks, if you like anything that I've just said, then you will love this video right here, a message from 2025. With that being said, my name's Chris Naugle. Thanks for joining me for another What Now, What's Next for 2025.